Hello everyone and welcome to Investment News TV. My name's James Burton here at Schwab Impact 2025 in Denver. And I'm delighted to be joined by Kathy Jones, Schwab's Chief Fixed Income Strategist. Kathy, thanks for joining us.
Hi, James. Good to see you.
Start maybe with the obvious headline stuff. Given your experience and perspective on the markets, have you ever known a time where the politics and the Federal Reserve are seemingly so intertwined or at loggerheads?
No, I think this stands out, and I've been doing this a long time. Stands out as the most overt pressure on the Fed from the administration. Now, having said that, every administration wants the Fed to do their bidding, and obviously behind the scenes, they're often applying some pressure. But this is really overt and much stronger and louder, I guess, than anything we've seen in the past.
Do you think it has had an impact on Fed policy?
No, I doubt that the votes would have been any different at the last couple of meetings. I do think, though, when we're getting speeches from various people on the Fed, they're more outspoken about their views about why they don't want to cut rates right now. So we've heard from the more hawkish members, and I think they're trying to demonstrate their independence.
Right. Has it impacted the market? There's a lot of talk, a lot of headlines. Do you think it's actually impacted the bond market?
No, I don't think so. No, I don't think so.
Right.
The bond market's doing its own thing, as it always has.
Yeah. Okay. Bringing it to advisors then. So as you spoke on stage yesterday and we looked at the different metrics, we talked about inflation and jobs market. What should advisors be focused on right now in terms of the data or lack of data at the moment given the shutdown?
Yeah, there's not much we can do. We can monitor the private sector data and the little bit that we're getting, but not much we can do until we start to get hard data again. But I think the bigger picture is that fixed income's doing what it's supposed to do for investors right now. We've had, year to date, every sub-asset class is demonstrating positive returns, some of them quite healthy positive returns. And I think that continues. And the lesson is if you have a good, strong core portfolio, meaning higher credit quality, intermediate term duration, you're delivering nice income, clipping those coupons, getting some added capital gains for your clients. And we think that continues into 2026. We think 2026 will be another positive year. So it's the no drama part of the portfolio. We got plenty of drama elsewhere. So enjoy the ride is what I would say.
Where in the bond market do you see opportunities? Or, you talked there about maybe some of the strategies, but where looks good?
Well, we like TIPS, Treasury Inflation Protected Securities. There's still a positive real return. So, you're going to get a return of a Treasury plus that extra yield over time, and that will keep pace with inflation. So in the past, that wasn't always the case. That started with negative real returns, but the starting point now is pretty attractive. So we think for some portion of a portfolio, TIPS makes sense. Investment grade corporate bonds, the spread versus treasuries is pretty tight, but the fundamentals are still good. So, and the coupon income is pretty attractive. So we would stay with that. And then municipal bonds, we know a lot of advisors have well-to-do clients in high tax brackets and high tax states. And municipal bonds, particularly if you're looking for longer duration bonds, have very attractive after-tax yields, or tax equivalent yields. And that's an opportunity as well.
On the flip side, anywhere to stay away from or anywhere that advisors should trade with caution?
I would say the leveraged loan market, so the lower end of high yield and leveraged loans. So the credit quality is quite low to start with, and we're starting to see default rates pick up. There's some fuzzy financing in part of that market that can backfire on you in stressful times. So we have an up in credit quality bias.
Fantastic. Kathy, thanks so much for joining us.
Thank you.
I appreciate it. I'll see you next time on Investment News TV.